Warren Buffett. You hear the name, you think investing genius. But what if I told you that his entire multi-billion-dollar strategy really just boils down to three simple numbers? Well, today, we're going to cut right through all the noise and show you the only three things Buffett really cares about before he buys a stock.
You know, if you've ever stared at a stock chart, you know the feeling. It's just this tidal wave of data, a blizzard of acronyms, and you've got all these so-called experts shouting different things at once. It almost feels like Wall Street is designed to be complicated, right? Like it's some secret language meant to keep normal people out. But what if all that complexity is just a big smokescreen?
And see, that's where Buffett's real genius kicks in. It's not about mastering the complexity, it's about having the guts to just ignore it. This quote right here, it's his entire philosophy in a nutshell. He believes that finding a great investment is actually pretty simple. You just have to know where to look.
So that's what we're going to do. We're on a mission. We're going to use Buffett's own logic to find the unique fingerprint of a truly great business, a simple, clear sign that cuts through all that junk. And it all starts with the very first of our three numbers.
Okay, so the first question Buffett asks is dead simple. Is this business actually any good at making money? I know, it sounds obvious, right? But his method for figuring this out is super precise. It all starts with profitability.
He uses this thing called return on equity, or ROE. Now, forget the jargon for a second. Think of it like this. If you handed a company one of your own dollars, how much profit could they spin that dollar into over the course of a year? That's what ROE tells you. It's basically the ultimate report card for how well the people in charge are using your money. And listen, Buffett is not looking for a one-hit wonder here. He has a very clear benchmark. He wants companies that consistently, and that word is absolutely key, generate a return on equity of over 15 to 20%. A business that can do that year in and year out has something special. It's the first big clue that you've found a truly wonderful business.
So let's say the company is a profit machine. Awesome. But how is it fueling all that growth? Well, that brings us to metric number 2. See, Buffett is famously suspicious of companies with too much debt. He wants a business that can pay for its own success, not one that's just propped up on borrowed cash.
And the number for this is the debt-to-equity ratio. This one's actually really easy to get your head around. It's kind of like looking at your own finances, right? You'd compare how much you owe on loans and credit cards to your total net worth. It's the same for a company. It just compares all its debts to the money that shareholders have put in. A high number here means the company is leaning way too heavily on debt.
Buffett just believes that a truly great business doesn't need to borrow a ton of money to grow. Too much debt makes a company fragile. You know, one little hiccup in the economy could turn into a total disaster. He's looking for a business that can survive pretty much any storm.
And here it is, the magic number. Buffett wants to see a debt-to-equity ratio below 0.5 or 50%. What that means is for every single dollar the shareholders own, the company owes less than 50 cents. That gives it this massive margin of safety. It's a clear sign of a strong, resilient business built like a fortress. All right, we found a profitable company that's financially solid. We're almost home. But there is one last absolutely crucial step, because even the best business on the planet can be a terrible investment if you pay too much for it. And that brings us to metric number 3, buying at a fair price. The classic way to check this is with the price-to-earnings ratio, or PE. Just think of this as the company's price tag. So a PE of, say, 20 means you're paying $20 for every $1 of the company's profit. Simple as that. So if two similar companies are out there and one has a PE of 15 and the other has a PE of 30, well, the first one is just plain cheaper. Now here's the thing. Unlike our first two metrics, this one doesn't have a single magic number. Buffett's whole philosophy on this is famously, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He isn't digging through the bargain bin. He's just making sure he doesn't get swept up in the hype and overpay for quality. The price just has to be reasonable. So there you have it, our 3-point checklist: high profits, low debt, and a fair price. But hey, theory is one thing. Let's actually put this simple framework to the test with a real-world, modern-day giant.
It's one of the biggest, most successful companies in history. But would Warren Buffett, using just these 3 simple rules, actually consider buying Apple? Let's run the numbers and find out.
Okay, here we go. First up, return on equity. Buffett wants over 15 to 20%. Apple's is often over 150%. That is a huge pass. It is an incredible profit machine. Second, debt to equity. Buffett's limit is under 50%, but Apple's is way over 100. So, a clear fail, right? Well, not so fast.
This is where judgment comes in. Buffett knows that Apple's debt is backed by a literal mountain of cash and super stable earnings, which makes it way less risky than that number looks. And finally, the PE ratio. It bounces around, of course, but it's often been in a range that Buffett would call reasonable for a company of this quality. So what we have is two big passes and one fail that's really more of an exception that proves the rule.
So what's the big takeaway here for you? After we've stripped away all the complicated stuff, what's the one thing you should really walk away with from all this?
It's this simple checklist right here. This is the fingerprint of a wonderful business. Is it super profitable? Does it have very little debt? And is it selling for a price that just makes sense? This three-step filter can instantly help you start separating the really high-quality businesses from all the rest of the noise out there.
And that brings us right back to where we started. You don't need some complex algorithm or secret source of insider info. Real investment wisdom, the kind Buffett practices, is all about focusing on a few common sense ideas and then having the discipline to stick with them.
So I'll just leave you with this thought. We just boiled down the core strategy of one of the richest people on the planet onto a single slide. It really makes you wonder, doesn't it? What unnecessary complexities are we dealing with in our own lives that are just noise we could choose to ignore? Thanks for joining this explainer.